The S&P 500 just had its highest daily close of all time, and that comes right in the same week as two major AI companies both dropped sharply after earnings. We have 2 weeks left of the year, and I want to discuss on what those 2 weeks look like, what we're seeing inside the market, and how we can prepare for 2026. I do believe, as always, there will be a lot of opportunities. However, I do think that we're going to have to be a little bit picky. So let's get right into it. First off, I want to talk about this Santa rally. I feel like every single year as we get into December, the Santa rally term gets tossed around. And I just want to clarify, December is generally a very good month for the stock market. However, the Santa rally refers to the last 5 trading days of December and the first 2 of January. The gains are very moderate at a 1.3% to 1.4%. I feel personally this year we're seeing the Santa rally term get tossed around a little bit looser because crypto is struggling, and a lot of your Tom Lee and your other huge crypto influencers are really pushing some of these 10, 15, 20, 30% gains in such a short period of time. So I just want to kind of like reset some of those expectations so you can prepare over the next 2 weeks. Now this week we do have a lot of data coming out, and it's important to just kind of take a note at this. So we have non-farm payrolls for both October and November being released tomorrow. Now, generally, non-farm payroll is released on the first Friday of every single month. However, we did have the government shutdown, which made it impossible for them to release these numbers. Now, last week, before Jerome Powell had spoke and actually had lowered interest rates for the 3rd consecutive month, the Trump administration had come out and said, listen, you're not going to get these numbers. Okay. And there was, in my opinion, only one reason for that. And it was because those numbers were bad. Now, every presidential administration is going to want to show 2 things: economic growth and job growth. It's just one of those easy indicators that any American can look at and say, oh, our president is doing a good job. The second reason the Trump administration, I don't think, would want to release these numbers, at least going back to last week, was because he has been adamant for Jerome Powell to lower interest rates faster. All right. And if any of this data skews that agenda, it might kind of insinuate to Jerome Powell not to lower interest rates. However, I'm sure he kind of has that data. So last week we weren't going to get these numbers. Now we're getting both months of tomorrow. We're also going to get the unemployment rate for November. Fast forward to Thursday, we're going to get the inflation rate. Now, it's been sticky around that 3%. I know, Jerome Powell comes out and the Federal Reserve states that they are really committed to getting back to that 2% target. Personally, I don't think we're ever going to get back to a 2% target unless we really slide into a deep recession. I think inflation is going to remain sticky, and they're going to formulate a new baseline somewhere in between that 3 to 4% range. The reason being for that is they're going to cut interest rates more than projected next year. We also have a new Fed chair coming in, which is going to be appointed by Trump, and is going to be a very dovish Fed chairman. Okay. So I do think inflation is going to stick around that 3 to 4%. Like I said, we're going to maintain a new baseline for that. We've got jobless claims. And lastly, on Friday, we have existing home sales, which is always very important because home sales account for anywhere between 16 to 18% of their GDP. Now let's get into a little bit of charts, and then I want to dive into what happened last week with those 2 companies and going forward. So as I mentioned right at the beginning of this video, the S&P 500 had its highest daily close of all time on Thursday, December 11th. Now it didn't quite take out that high on October 9th. However, when you look at the daily close, it did get above that. The S&P 500 is still very strong. While a lot of stocks you're seeing pulling back 20, 30, even 40% off of all-time highs, it's important to notice when one of 2 things are happening, okay? You have a few different major indices. You've got SPY, you've got QQQ, which is pretty much your tech sector. You've got your Dow Jones, which is your top 30 companies, as well as your IWM, which is your small caps, and your Russell 2000. Now, when you start to see indices reacting a little bit differently. And what do I mean by that? Well, when one, let's say, is, consolidating, maybe one or two are pulling back and one of them is actually rising, it's important to notice that that is when money is just rotating. Okay. Capital is staying inside the market. Investors are just shifting between what they're investing in. Now, when you start to see all of those major indices pulling back, pretty much the same amount, maybe it's varied by different percent, but all the charts look very similar, that is when money is leaving the market. It's very important to identify what is happening, and therefore you can take a look at what your portfolio is doing, and maybe if you're invested too heavily into one sector, and maybe it's time to rotate out of that. Okay. Now, last week we had two big companies report. The first one was Oracle. Now, Oracle has had, we'll look at the weekly chart just to give you a little bit better a picture here. Oracle had a monster run ever since that April low, getting down to about 120 after the tariff tantrum, I'm going to call it, getting all the way up to 350, kind of selling off, bouncing going into earnings, and then dropping about 12% after earnings. That was the first one that was released on a Wednesday. I feel like that had really started up a lot of AI fears, and we'll dive into that in just a moment. The next one was Broadcom, which is a bigger player. They have a much better financials and I believe a stronger portfolio leading into this AI sector. They came out as well and they pulled back probably, I think it was a little bit less, going into earnings, to hit a high of about that 420, dropped off, and actually have continued to sell off even into today. So let's take a look at what happened. There's a couple differences. And like I said, 2026 is going to be a little bit tricky to navigate. So Oracle came out and their cloud, and they dropped for three main reasons. Their cloud revenue had missed analyst expectations, and they also lowered guidance. So earnings can be very tricky. Earnings come out after the quarter and they're rear facing. However, investors don't really care what you did last quarter. They want to know what you're going to do next quarter. They want to see revenue is going to be up. They want forecasts to be higher. Okay. And they want growth to continue at a faster rate than your expectations. That means that stock is going to jump. There's two terms for that: forecast and guidance. They lowered guidance, basically saying, listen, revenue's not going to be as strong as we expected. So that was a big concern for investors. Second reason is their massive new spending. They decided to raise their CapEx to $50 billion. Now, there's a lot of issue going around in the AI narrative right now of too much spending, and are we going to see a return on investment quick enough? Investors want to know, if you're spending X amount of dollars, that X amount of dollars is going to have a return on investment. So picture, Facebook or Meta, when they were investing tons of money into the metaverse, their stock was pulling back pretty heavily because investors were just like, I'm not sold on this idea of everybody living in the metaverse and the metaverse having a return on their, investment of what Meta was spending it on. Similar thing is happening inside the AI sector as of right now, but it's really, narrowed down to specific companies, and Oracle unfortunately is one of them. They are swimming in debt. They do not have a good free cash flow at all, and this, I think, is just raised a huge red flag to investors. Like, you're already struggling, you're not quite even showing potential ROI as of yet, and you want to spend more money. That was the big issue, which is why Oracle decided to sell off. Broadcom was a little bit different. I think it kind of piggybacked, and as you can see right here that I have on number 3, following the Oracle earnings jitters, their main reason for selling off was their margin pressure. Now, the company is receiving high requests for custom AI processors and system, and anything that's custom is very good for the customer. However, it takes a little bit more labor and software development in order to get that out there. It's not off the shelf where they can just sell. However, the margin, I believe the numbers went from like 79% to 76%. So they have really good margins, and I think it was a bit of an overreaction. However, another one, like I said, piggybacking off of Oracle, was their lack of guidance. So they didn't lower guidance going into 2026. They just didn't really give guidance. And I think, after Oracle just reported the day before, there was a lot of uncertainty with that going into next year. Now, This all started, and it's important for you guys to kind of get a bigger grasp on exactly what is happening. So this all started a little over a month ago. You know, OpenAI has been one of those companies that has had multiple deals with many different companies. They have also promised to spend tons of money and utilize, other equipment, whether it's chips or software from other companies. And there's a lot of discrepancy happening. And so about a month ago, Sam Altman, which is the Open AI CEO, had said, listen, we expect to end this year above $20 billion in annualized revenue run rate. And they're expecting it to grow by hundreds of billions of dollars by 2030. Investors are very skeptical off of that because 80% of their revenue comes from their $20 a month subscription service. Okay. Google has come out with Gemini. Because Google has so many other revenue verticals, if they decide to make their one of their top tiers, or at least a mid-level tier of Gemini free, that is going to put a big dent into OpenAI's revenue. But Sam Altman said they expect to grow to hundreds of billions of dollars by 2030. And they're looking to make commitments of about $1.4 trillion over the next 8 years. Now, that math just isn't math. And currently, you're $20 billion of revenue. Let's even say you grow to $100 billion worth of revenue, but you're going to invest $1.4 trillion in commitments. I do believe that they are probably going to go public either next year or the year following. They're going to have to in order to raise that kind of capital. But that's where all of this, kind of speculation of an AI bubble had started. I don't know if you've seen this chart, but it's been tossed all around the internet, and OpenAI really plays a huge part in this. This chart is what shows what is called circular funding. Now, circular funding, it gets a bad rep because a lot of people look at it as, you're robbing Peter to pay Paul. However, it's very normal for a company who has, positive cash flow to be able to take their money and invest it into other companies in order to grow. It's something that NVIDIA is doing. NVIDIA is very cash heavy, and they say, listen, if we can, invest money in some of these startups, and then in return, that startup succeeds, and then they buy our chips, that's going to be good for us. However, there are going to be startups that NVIDIA does invest in that do fail. That's normal. But this chart kind of gave a bad, speculation about what is happening inside of the AI space, of just all of this money just kind of circulating, and OpenAI plays a big factor into it. So right now, like I said, I don't think the AI narrative is far from over. I don't think it's dead. I just think investors are going to need a little bit more, a surety moving forward, which is fine because, a lot of your AI stocks, your AI companies have really just taken, seen some insanely vertical growth. You even look at this one, 140 all the way up to 420 in such a short period, less than a year. So it's okay to see a bit of a pullback, get some concerns, build another base. Some of the companies that are not positive, really strong, such as Oracle, which I didn't show this lat chart, which shows that free cash flow. Oracle is just, swimming in debt, and their projections are even worse going forward. But take a look at some of those companies and be able to, invest in them going in the future. As we go through the next few weeks and the next few months, and, this AI, concerns do start to cool, I will make more videos talking specifically about other stocks. But lastly, I want to talk about is the sector rotation. So you have IWM, which is your Russell 2000. IWM has been consolidating for years. It came up here back in November November of 2024. It looked like it was going to break out of an all-time high. Then we fell into the end of the year, obviously the terrorist concerns, and here we are breaking out to new highs. This chart looks very different right now on a shorter term than the tech sector. As you can see right here, we'll switch to a daily chart. The tech sector, which is all of your AI, is struggling right now. It's not making an all-time high. So that's where you start to see, some of the rotation happening. There's a lot of stocks inside of the small caps, which once again, I will make another video more focused on, that have really lagged. Okay. You can think about a few handful of small cap stocks that have really gone vertical over the last, couple of years. You look at Palantir, which is the most notable, Robinhood. Upstart's had its moments, not anything coming back of that 2021. SoFi, same thing. I want to say, too vertical, but you look at these, basket of stocks that have gone vertical, but a lot of the stocks inside of the Russell 2000 and small caps haven't quite broken out yet. And I want to take a look. I want to show you this chart right here. This chart is another very popular one that gets passed around on the internet. And, people like to create content around of guessing where you are. This stock or this chart shows the psychology of the market cycle. Okay. And I'm not going to even dive into where I believe that we are right now in this cycle. But another thing that has market cycles is what, sectors are being invested into. And this is one I like to look at forward, PE ratio. So if you look at right now, the current, PE ratio of the entire S&P 500, this is a very good metric to look at on whether you are investing in an overvalued market or an undervalued market. But right now we are sitting at a 23, which we're a little bit high. Obviously the AI, sector and this forward projected growth is really carrying us moving forward. But naturally, as we, get up higher into this, PE ratio, you'll see a lot of sector rotation, something I just talked about, where investors will pull away from your tech stocks, your speculative stocks, and they will look for two things. They will look at your value stocks, which is, your Home Depot, your consumer discretionaries, your McDonald's, your Dollar General, your healthcare sectors potentially, but they will also look for small caps that are kind of just lagging. Okay. And I think that plays a very good indicator on potentially of where we can be at, where we're at, and where 2026, the opportunities that might give us. If this breakout holds above these, November of 2021 and November of 2024 highs, I would expect a lot of small caps that really have just been ignored. I'm not talking about too highly speculative, but small caps that have been ignored, that have been laggers over the past few years, but still companies that are showing promising fundamentals, some of those stocks to really get some gains. So guys, that is it for this video. Thanks for staying with me. If you made it this far, like I said, it was about 2.5 years since I made a video behind this desk, but I'm excited to be back. Leave a comment down below and I'll see you in the next one.